Okay, some quick reminder wrap-up type things for this week. Retained earnings, also known as earnings capped. If we think of the word retained itself, means capped. Also could be called net profits capped. I've seen it in some financial statements as accumulated earnings. We're going to deal with retained earnings, but this is the meaning of it all. Formula for that is last year's retained earnings plus this year's net profits minus or less this year's dividends. Okay, another reminder, accumulated depreciation, that's the amount of depreciation, or as I mentioned earlier, we can also call it in this course amortization, expense that's used up on a long-term asset. Okay, remember it's long-term assets we're talking about, and they get used up over more than a year. So we accumulate that to make the balance sheet balance and give us a net value or a book value of the long-term asset. Basically, last year's accumulated depreciation, so accumulated depreciation December 1st, plus this year's expense gives us the accumulated depreciation. Okay, and the bottom two notes are fairly self-explanatory. Now, this next little bit has been generated by a couple of student questions, so don't feel like I'm talking down to you. It's just helped to simplify the situation. Ratios are fractions, and of course if the numerator increases, the ratio increases. Short, sweet. If the denominator increases, the ratio decreases. Okay, so far so good. Okay, one of the funny things about debt to equity is I call it a backwards ratio, because it's one of those ratios where the smaller the number, the better. We encounter another couple of those ratios later on in the course. But of the key ones, the ones we've looked at so far, debt to equity is reversed to the other ones. The other ones all we want normally a bigger number. Debt to equity is kind of reverse. So it's kind of, like I say, backwards. So what that means is if the debt increases, so the money you owe to bank or other people or not shareholders also, if it's a shareholder loan, but suppliers, that sort of thing, if that increases, then the ratio goes up. And if the equity increases, the ratio goes down. If you're a banker, you don't like to see that ratio go up. So these are sort of things bankers look at. So if the debt increases, the debt to equity ratio goes up. If the debt decreases, debt to equity ratio goes down. How does equity increase? Well, we can sell some shares. That increases the shareholders' investment in the company, means additional owners. They put in more money when they do that. As well, we can keep profits in the company every year. Instead of giving out dividends, we can leave the profits in the company. How does equity decrease? Well, obviously by having dividends or losing money. Now, the ideal number is 1 to 2, and this is for a couple of reasons. Shareholders want to maximize the return on their investment. So if they have somebody else lending money to the company, then really they're not putting money in the company. So in that sense, they get a better return on their investment or on their equity. Banks, of course, don't want to do that. So the ideal over the years has come to mean 1 to 2. Again, this is pretty much a small business number. And this means that for every dollar the bank or lenders have in the company, they want to see that the owners have $2 in the company. Nice sort of simple thing. So if the bankers have $1 and the investors have $3, then the number goes down to 0.33 instead of 0.5, and bankers and lenders like that quite a bit. Because the company owners have a lot more money in the bank or in the company. As you may have noticed during the ratio things we've been doing, some numbers have show up many times in the ratios. Net profit or net income after taxes, earning after taxes, whatever you want to call it, shows up, of course, in the net profit margin. If we look at the return on earnings, if the net income comes up, the return on earnings ratio is up. Same with return on assets, return on investment. So those are 3, 4 ratios that if we increase the net income or the net profit, then those ratios increase too. Other numbers that show up, operating profit, also known as earnings before interest and taxes, shows up in the interest coverage and fixed payments coverage, and we'll see some of these numbers show up later in other ratios. So it's important to note that there's an interplay between the ratios sometimes too, just because of one number. Most often you're looking at net income, but just because of one number increasing or decreasing.